There are several methods for investing. Here are some of the most common ones. Stocks. Investing in stocks involves buying shares of a publicly traded company. When you invest in a stock, you own a small portion of the company and share in its profits and losses. Stocks are typically considered a higher risk investment because their value can be volatile and affected by a wide range of factors, such as economic conditions, industry trends, and company-specific events. Bonds. Investing in bonds involves loaning money to a company or government in exchange for a fixed interest rate. Bonds are generally considered a lower risk investment than stocks because they offer a fixed rate of return and are less volatile. However, the potential returns on bonds are typically lower than the potential returns on stocks. Bonds can also be affected by factors such as inflation and changes in interest rates. A mutual fund is a type of investment that pools money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. The fund is managed by a professional fund manager, who makes investment decisions on behalf of the investors. Investors buy shares in the mutual fund, and the value of their shares is based on the performance of the underlying investments. Mutual funds offer a convenient and accessible way to invest in a diversified portfolio of assets, without having to make individual investment decisions or conduct extensive research. There are different types of mutual funds, including stock funds, bond funds, and balanced funds that invest in a mix of stocks and bonds. Some mutual funds are actively managed, where the fund manager makes investment decisions based on market trends and research. Other mutual funds are passively managed, where the fund tracks a specific index, such as the S&P 500. Mutual funds can be a good investment option for those who want to diversify their portfolio and benefit from professional management. However, they also come with fees, such as management fees and expense ratios, that can reduce investment returns. It's important to carefully research and compare different mutual funds before investing, and to consider factors such as fees, performance history, and investment objectives. An exchange-traded fund, ETF, is a type of investment fund that is traded on stock exchanges, much like stocks. ETFs are designed to track the performance of a specific index, such as the S&P 500 or NASDAQ, or a specific sector or commodity. ETFs are similar to mutual funds, but they trade on exchanges like stocks, allowing investors to buy and sell shares throughout the trading day. Like mutual funds, ETFs offer a way to invest in a diversified portfolio of assets, but with the added benefit of being able to trade them like individual stocks. ETFs typically have lower expense ratios than mutual funds, making them a cost-effective way to invest in a diversified portfolio. Additionally, ETFs are generally more tax-efficient than mutual funds, since they have lower capital gains distributions. There are different types of ETFs, including index ETFs, bond ETFs, sector ETFs, and commodity ETFs. Some ETFs are also actively managed, while others are passively managed. ETFs can be a good option for investors who want to diversify their portfolio, gain exposure to specific sectors or asset classes, or trade more frequently than they could with mutual funds. However, like any investment, ETFs come with risks, and it's important to carefully research and consider factors such as fees, liquidity, and investment objectives before investing. Real estate investing involves buying and owning properties, such as rental properties, commercial buildings, or land, with the goal of generating income or appreciation over time. Real estate can be a long-term investment, with potential benefits such as steady rental income, tax advantages, and property value appreciation. Real estate investing can take many forms, such as owning a rental property, investing in a real estate investment trust, REIT, or buying and flipping properties for a profit. Owning rental property can generate steady income through rental payments, but it also comes with responsibilities such as maintenance, repairs, and tenant management. REITs are companies that own and manage income-producing real estate, and investors can buy shares in the company like a stock. REITs can offer exposure to a diversified portfolio of real estate assets, with potentially lower investment costs and greater liquidity than owning physical real estate. Real estate investing can be a good option for those who want to diversify their investment portfolio, generate steady income, or take advantage of potential property value appreciation. However, it can also be a complex and risky investment, and it's important to carefully research and consider factors such as location, property condition, and market trends before investing. Additionally, owning physical real estate requires significant capital and ongoing management responsibilities, so it may not be suitable for all investors. Commodities are raw materials or primary agricultural products that can be bought and sold, such as oil, gold, wheat, or coffee. Commodity investing involves buying and selling these raw materials with the goal of profiting from price changes over time. Commodities can be traded in various forms, including futures contracts, exchange-traded funds, ETFs, or physical ownership of the commodity itself. Futures contracts are agreements to buy or sell a specific commodity at a set price on a future date, while ETFs are designed to track the performance of a specific commodity or basket of commodities. Commodity investing can offer diversification benefits, as commodities can have a low correlation with traditional stocks and bonds. Additionally, commodity prices can be influenced by a wide range of factors, including supply and demand, geopolitical events, and weather conditions, offering the potential for significant returns. However, commodity investing also comes with risks, such as high volatility, uncertainty around supply and demand, and the potential for price manipulation. It's important for investors to carefully research and consider these factors before investing in commodities, as well as to understand the specific risks associated with different commodities and investment vehicles. Options trading is a type of investment strategy that involves buying or selling options contracts, which give the holder the right, but not the obligation, to buy or sell an underlying asset, such as a stock or commodity, at a predetermined price and time. There are two types of options contracts: calls and puts. A call option gives the holder the right to buy an underlying asset at a specified price, while a put option gives the holder the right to sell an underlying asset at a specified price. Options trading can be used for a variety of purposes, such as hedging against potential losses, generating income through option premiums, or speculating on market movements. However, options trading also comes with risks, such as the potential for significant losses if the market moves against the investor, and the complexity of options contracts and strategies. It's important for investors to carefully research and understand the risks and potential benefits of options trading before investing. Additionally, options trading requires a high level of knowledge and experience, so it may not be suitable for all investors.